Good afternoon and welcome to this webinar. My name is Charene Nortier and I am from the Conduct of Business Supervision Division at the FSCA, and that is a mouthful to say and to remember. Today's topic is premium collection and specifically the legal aspects around premium collection. I'm really fortunate to be joined by two of my colleagues from our Regulatory Frameworks Division. And I'm going to ask Lezanne Botha to just explain what they do and introduce herself and her colleague.
Thank you, Charene. Good afternoon, and thank you very much for this opportunity. We certainly appreciate all the opportunities we get to engage with the industry, and we hope that this afternoon will add value to everyone who watches the webinar. My name, as Charene said, is Lezanne Botha. I am a Senior Manager in the Regulatory Frameworks Department at the FSCA. And what we do is we are responsible for the drafting and the maintenance of the regulatory framework. We do all the legislation for which the FSCA is responsible. And with me this afternoon is my colleague Johann van der Lith. Johann is a regulatory specialist in the Frameworks Department. And between Johann and myself, we are responsible, amongst other things, for the insurance regulatory framework. So, Charene, shall we begin?
Lezanne, thank you very much. Now, as I said, I'm really pleased that you and Johann were able to make yourselves available for this discussion. We get a lot of queries and a lot of complaints around premium collection. It's probably one of the topics that keeps many of the colleagues in conduct of business and in colleagues in departments like yourselves really busy on a constant basis. So we thought it would be very useful to have two sessions around premium collection. Today's session is around the legislation, and we're going to specifically talk about the insurance legislation and the FSCA legislation and where they interact with one another as well. And then we're going to have a separate session with FSCA colleagues and insurance colleagues talking about the practical realities and implications of collecting premiums and accounting for those premiums. So I do hope that everyone watching today's session will also watch the next session on the practical implications. But without any further ado, we've mentioned the legislation very briefly, but Lezanne, could I ask you to expand a little bit about the applicable legislation?
Certainly, thanks, Charene. So the start is setting out the various frameworks that are applicable. So premium collection activities includes all activities relating to receiving and accounting for premium, and that constitutes services as an intermediary. So there are two distinct and separate regulatory frameworks that apply to premium collection. It can therefore be said that there's a dual regulatory framework that has to be considered if you start considering the legal aspects of what applies to premium collection. Firstly, I think importantly, is the FSCA framework. That is the Financial Advice and Intermediary Services framework under the Financial Advice and Intermediary Services Act. The FSCA framework sets out the definition for intermediary services, which includes accounting for and collecting premium. So the FSCA framework was put in place, I think if I recall correctly, in 2004, and the primary aim of this framework is to deal with the regulation of financial advice and also intermediary services to clients. The Act's main objective is to ensure that policyholders and all customers that make use of financial products and that receive financial services are protected, and to ensure the professionalization of the financial services industry in as far as it relates to intermediary services. So opposed to the FSCA framework, we also then have the insurance framework. The insurance framework, as it currently stands, consists of three primary acts and then subordinate legislation under it. There is the Insurance Act. For purposes of our discussion today, that is not really relevant. It sets out that the Insurance Act sets out the primary legislation for prudential supervision of insurance, but you've got the long and the short-term insurance acts that deals respectively with elements of the conduct of business of life and non-life insurance business. I think what's important to also note, most people involved in the industry might already know it, but previously we used to refer to long-term insurance and short-term insurance, and the names still remain because that's the names of the acts. But actually, the terminology has changed over time. So now we refer to life or non-life insurance. And the Long and the Short-Term Insurance Act respectively looks at the conduct of business-related aspects of insurance, and also specifically the business relationships between insurers and their business partners, such as intermediaries. And where premium is collected on behalf of an insurer, there's certain requirements that set out in those frameworks. So those legal requirements, back to the FSCA Act, the legal requirements there predominantly relates to licensing of a financial service provider. Any person that wants to conduct intermediary services as defined in that act needs to be authorized as a financial service provider. And if you look at the definition of intermediary services, which includes the collection of or accounting for premium, it means, just in simple terms, if you want to collect premium on behalf of an insurer, you have to be an authorized FSP under the FSCA Act. The Long and the Short-Term Insurance Act, again, the regulations under those acts sets out the legal requirements, goes into a little bit more detail, and it sets out the legal requirements for collecting of premium on behalf of an insurer. It includes, for example, written authorization, requirements relating to the receiving of premium, including, for example, collecting premium into a separate bank account, and Johann's going to speak to that a little bit later. And then also it sets out what remuneration is allowed for performing these activities on behalf of insurer. I'm just going to move on. So you on the screen now, you will see 3 distinct definitions. The reason why we're trying to illustrate this is just to explain this dual regulatory framework that applies, and to specifically highlight to everyone who's watching this webinar how collecting or accounting for premium fits into these 3 frameworks. You'll see the definition there under the FSCA Act that I mentioned, intermediary services, and it includes the collecting or accounting of premiums or other monies payable by a client to a product supplier. A product supplier would include an insurer, and in respect of a financial product. So as you can see, intermediary services, amongst other things, includes premium collection. Under the short-term insurance regulations, similarly, interestingly, you will see that the terminology is slightly different between the pieces of legislation, but the message that we want to bring across is that all 3 of these definitions includes collecting or accounting for premium in one way or another. So you'll see, and there's a different definition in the regulations under the Long-Term Insurance Act as well, but similarly includes collecting, accounting for, paying premiums, or providing administrative services in relation to a prop policy. Just one other point that I'd want to make, Charene, going back to the previous slide, is it's important to note that premium collection is not outsourcing. Cannot be said to be outsourcing because legally it falls within these definitions that we've explained today. So for all intents and purposes, in terms of the current framework, premium collection and accounting for premium, it forms part of services as an intermediary. I hope that clarifies it, Charene.
Thank you, Lezanne. That was definitely very edifying. I like the way that you've explained the 2 frameworks, and that there is a duality in terms of the regulations that people have to understand. Because I think sometimes there is a temptation to focus on one set of legislation and not necessarily consider all the implications of the other legislation that is applicable as well. Johann, if I could ask you to just pick up and expand a little bit about the authorization that is required. And I know that Lezanne has spoken in quite a lot of detail around this, but if you could just carry on with that theme and expand a little bit, I would appreciate it.
Good afternoon, everybody. Thank you, Charene. I will do so. So Lezanne explained that the premium collection activities constitute services as intermediary. What flows from this, in terms of the insurance framework, is that there must be authorization by the insurer to perform the services as services intermediary on behalf of that insurer. And this requirement is set out in Section 45 of the Short-Term Insurance Act, and also Section 47A, capital A, of the Long-Term Insurance Act. You will find specific requirements for this authorization in both the long-term and the short-term regulations. So the regulations, as alluded to, requires that the authorization must be in writing. Together with this, there's other matters contained, specified in Part 4 of the short-term and Part 8 of the long-term regulation, and these include that authorization and also specifies aspects like the level of standard and operational requirements that must be met at all times to render these services under that authorization that is provided by the insurer. In addition to these requirements in the insurance framework, and again, we alluded to it that it's a dual framework, so we have to look at the phase framework as well. So in the phase framework, any intermediary collecting premiums must have been granted authorization, but that authorization is to act as a financial services provider, and it's given by the Financial Sector Conduct Authority. So any person that wants to collect premium may only do so if licensed under Section 8 of the Phase Act. Thank you.
Thank you, Johann, and that's very important because many institutions and persons think that as long as they have an agreement with an insurance company, then they don't need to have the phase authorization as well. So
Yes.
It is important that both of those have to be in place.
That's correct.
Perfect. Lezanne, if I could ask you, we have different methods of collecting premium. So we have the so-called traditional collection of premium, and then we have what is called a direct collection of premium. Could you expand a little bit about the differences between the ways in which premiums are collected?
Certainly, I can do that, Charene. So I think it comes with, the development over time. Initially, there was only one way of collecting premium. And if you think about the days before we had all the wonderful technological systems, typically you would have your intermediary come to you, physically collect cash when cash was still king, collect the cash from the policyholder, take that money and go pay it over to the insurer or into an insurer's bank account. So if you think about it in that context, the traditional collection of premium refers to where a third party, an intermediary, performs these activities of physically collecting or receiving insurance premium into a bank account of that intermediary. So the FSP in this instance would receive the premium on behalf of the insurer, and then once it's collected, pay the premium over to the insurer. But because of a number of reasons, the legislation is formulated that it actually allows the intermediary to hold on to that premium for 15 days after the end of the month. So effectively, it can be up to 45 days that an intermediary can hold onto the premium and still be within the confines of the law. Over time, however, and because of technology, there's been new ways of collecting premium. Specifically, if you just think about the involvement of the payment systems framework. So opposed to the traditional collection of premium, there's what we call direct collection of premiums. So in the traditional collection of premium, as we have it up there on the slide, there are two steps basically. The policyholder's money goes to the intermediary and the intermediary pays it over to the insurer. So that's the flow of the funds. In terms of direct collection of premium, the money flows directly from the policyholder into a bank account of the insurer. Essentially, it means that the intermediary doesn't touch the money. They do not receive that money. They simply facilitate it. Now, thinking in the context of IT systems and payment systems, what happens quite often these days, especially in personal lines business, is the intermediary has the appropriate systems in place to facilitate this payment. They do all the administration around the payments, collecting of the premium, but the flow of the money is no longer policyholder, intermediary, or insurer. It flows directly from the policyholder to the insurer. And the intermediary and the benefit that they add and the value that they add is setting up the IT systems, accounting for the premium, and doing similar tasks for the benefit of both the insurer and the policyholder. So maybe just from that perspective, I think that's essentially the difference between the two. We, as the FSCA, have been quite vocal in saying that as a norm, we think that collection of premium is a valuable change in the sector. because it reduces risk. The money flows directly from the one to the other. There isn't a risk of money being inappropriately applied, or there's been some abuses in the past. So as a general rule, we've said we support the move to direct collection of premium. That said, that's by no means across the board. There are always exceptions to the rule. So we do acknowledge that there are some types of insurance business where the third-party collection still adds value. But as a general rule, we support the move to direct collection of premium. I think that would answer your question, Charene, and I hope so.
Yes. It does. Thank you very much, Lezanne. That was very clear, and it does explain the difference between the role players and the different parties as well. But if we continue on the discussion of the parties involved, Johann, I'm sure that people don't do this for free, that they do want some kind of remuneration for it. There's nothing like mahala in this environment. So could you talk a little bit about remuneration? What is allowed, what is not allowed, what should people be aware of?
Definitely correct on that point, Charene. So I think it flows from the classification, as we explained, of premium collection and how it's positioned within our current framework. So if you look at that position and the classification currently, remuneration for performance of premium collection activities is limited to regulated commission. And it may not exceed the commission limitations, and those are contained in the regulations under the short-term and the long-term regulations. So, Charene, there are limited exceptions to this rule. For example, when an entity performs activities related to direct collection of premium, some additional remuneration is allowed, and we have provided for that. But that is only if the entity qualifies in terms of an exemption granted by the FSCA. So these exemptions that we have granted are aimed at facilitating the payment of additional remuneration to an independent intermediary, but only where those premiums are collected directly into the bank account of the insurer and the technological systems available to that intermediary enable the direct collection method. As Lezanne explained, there's for us a move towards that, and we facilitate that in this way. It must be noted that the exemptions are granted subject to certain conditions being met, and only if the premium is collected directly in the bank account of the insurer through the use of these information technology systems. And the reason why this remuneration is allowed is because this type of collection, as Lezanne said, reduces risks in our views. It also creates efficiencies, and this ultimately leads to better protection and lower cost to the policyholders. If we look at the phase framework, remember we said that the dual framework applies. We look at section 3 capital A sub 1A of the General Code of Conduct for authorized financial services providers and representatives in 2003, and that is issued under the Phase Act. A provider or its representatives may only receive or offer the financial interest set out in this section. So that's from a phase perspective. In this context, and we're speaking about premium collection, this means that the provider or its representatives may only receive or offer commission or fees that are authorized under the Long-Term and the Short-Term Insurance Act as financial interest from or to a third party. So in terms of this context, the only financial interest authorized under the Short-Term and the Long-Term Insurance Act for premium collection activities is commission, as explained, within those limitations that are contained within the regulations. Thank you.
Johann, thank you. That was very clear, but you mentioned an exemption. Could I ask you to expand a little bit more about the remuneration under the exemption, please?
Not a problem. I will do that, Charene. So the scope of the exemption that we provided first, we have extended that scope to provide for additional remuneration. So if we look at accounting of premium, we've defined that within the exemption notices to mean the rendering of one or more of the listed information technology systems driven in relation to premiums. So it's very important to note that these exemptions do not intend to create an additional income stream for those who traditionally did the third-party collections and nothing else. In these instances, the intermediary is already remunerated by way of commission. So the FSCA has been very clear that it supports direct collection of premium in the bank account of the insurers, becoming the norm instead of the exception, as we stated, and the direct collection method addresses some risks that we had. So if we look at this remuneration that can be given for the activities, it's very important to look at the definition of accounting of premium and what do we see constitutes accounting of premium within that definition. So there's a variety of activities that is listed within the exemption notice, and you also see on the screen now that this is illustrated on the slide. So if we go quickly through those are the provision of payment processing services, which includes payment gateways consisting of hosting of one or more gateways and routing of premium payment transactions as well. It also includes financial processes and data transfer consisting of bank account validation, verification, and premium payment tracking, and also system-based recognition of revenue conducted through the raising and allocation of premium. So more detail you can find within that definition. So I'm just highlighting the main elements of what we have defined. So there's also a provision of system controls, and there's a list within the definition there which alludes to fraud detection, reconciliation of premiums, and also the reporting to the short-term insurer. And that is by way of emailing reports, for instance, pre-validation of systems and reporting on bank rejection codes. So if you perform these services, then you're allowed this additional remuneration, but still the general principles of remuneration do apply, that it shouldn't be in duplication of what you have already received as rendering services as an intermediary by way of commission. So the duplication, and of course it has to be in line with the actual activities that is being performed. So I hope that answers the question, Charene.
Johann, it does. Thank you very much for clarifying that, because this becomes quite tricky for people to understand what is covered under commission and what are then constituting the additional services for which additional remuneration may be earned. I really appreciate the extent to which you've clarified this for us. But if I can ask you to also talk to me a little bit about sub-outsourcing. Is that allowed? Is it not allowed? What are the restrictions around this? So if I have the contract, can I contract with you?
So we did allow for this in the current exemption notices, because we do find that in the industry it's currently being done in this way. However, the FSCA communicated through various communications to the industry that we remain uncomfortable with outsourcing these activities, where it's independent intermediaries and they enter into remuneration agreements with other independent intermediaries to perform these activities that falls within the definition of service and intermediary, as we explained, on the short-term insurance regulation side, or rendering services as intermediary in the long-term regulations. So the authorization that we spoke about earlier in terms of Section 45 of the Short-Term Insurance Act and Section 47 capital A of the Long-Term Insurance Act is still required if there's two intermediaries performing these services of accounting of premium. So there is no sub-delegation of this authorization allowed. So the insurer has to authorize then both of these intermediaries, and any remuneration paid must still comply with the general principles that I've stated of fair remuneration, and these are also set out in the exemption notices. And this means that the remuneration must be reasonable and commensurate with the services being performed, although there's these two independent intermediaries performing these services together. And the systems required to perform these functions that this remuneration is paid for must be the technological systems that we have spoken about. and they must not be remunerated for performing a similar function twice in respect of the same policy on behalf of this insurer that provided the authorization. So I hope that provides clarity on that.
Johann, thank you very much. And I think the principle is, and I'm going to simplify it a lot, is that it mustn't cost the client too much money. It must be reasonable to the services that are rendered. And the client must not be out of pocket because there are duplication of services or duplication of service providers.
Yes, that's indeed correct. That's a good summary of that.
Excellent, thank you. If we continue on the theme of just accounting for the money, we like in the phase environment to say that the client's money must not be intermingled with the FSP's money. There must be a clear demarcation between what is the FSP's operating expenses and what money doesn't belong to the FSP, because it is either the client's money or the money is already in custody on behalf of the product provider, in this instance, the insurance company. How does this separation of money work in practice? Must there always be a separate bank account?
I think that's an important question, Charene, because there are various risks that is created if there's a commingling of these monies that comes from the policyholder. So in terms of Section 10, Sub 1D of the General Code of Conduct for authorized financial service providers and representatives, that's under the FASE Act. The provider who receives or holds financial products or funds on behalf of a client must account for such products or funds properly and promptly and open and maintain a separate bank account. And that is designated for clients' funds, which is opened at a bank. So that is one requirement that's provided for in the General Code. So just a little bit more about this specific requirement. It must be noted that Section 10(1)(d) has always applied to collection of premiums on the long-term insurance side. But if FSP collecting short-term insurance premium has, however, always been excluded from this application of Section 10(1)(d) by virtue of Section 10(3) of the General Code of Conduct. So this becomes a little bit complicated, and it's maybe good for somebody to maybe read the General Code of Conduct to understand this properly. But I just wanted to mention that the FSCA is in the process of amending this General Code of Conduct, which will result in the long-term insurance premium also being excluded. And that brings alignment between the long and the short-term requirements. So as a general rule, in terms of the short-term and long-term regulations, and now we're speaking about the insurance framework again, there's regulations 4.2 in the short-term and 8.2 in the long-term regulations that requires the independent intermediary to maintain one or more separate bank accounts into which premiums are received. So these regulations further require that the separate bank account may only contain monies collected from policyholders and may not contain any monies or funds of the independent intermediary. So you'll note here that the word monies are being used and not premiums, so it's a little bit wider than premiums. And what is specifically also stated here, and that's important to note, is that all premiums electronically received must be received into this bank account. And any cash received must be deposited into this account within 1 business day. So all the money must go into the separate account, and the FSCA did consider exemption applications, and we've seen that there was practical challenges in the industry in regards to this. And we've also had some engagements with the industry, and we became aware of several types of business models that are experiencing practical challenges when you look at the strict application of regulation 4.23 and 8.22 in the long term, respectively. And this prompted the FSCA to issue exemption application to certain intermediaries, and that is to assist these practical challenges that they have experienced. So the ones that have been issued is FSCA Insurance Notice 4 and 5 of 2020, and they provide exemption to independent intermediaries. insofar as it relates to receiving, holding, or in any other manner dealing with premiums payable to a short-term and long-term insurer. But this is where rendering services as the intermediary is not the primary business of the independent intermediary, and also that this collection is consequential to a credit agreement or other type of commercial agreement. So there was also an extension for these exemptions that were given. So they were issued quite recently, and they extend these exemptions to 31 March 2024. So there's some extra leniency provided until that date.
Johann, thank you very much. And I think that people are very appreciative of the additional leniency that has been granted. But if we continue to talk about the practical implications, so if I am an FSP, can I, for practical considerations, collect money into an operational bank account and then split the money out into a separate bank account? Because sometimes I think that might be a practical issue that FSPs are grappling with.
Yes, well, the answer to that is no. The general rule is that you may not receive premium into an operational account, which is then commingled with other monies together. So the premiums must be received into the separate bank account, as I've stated, that Regulation 4.2 and also Regulation 8.2 of the long-term regulations, unless you're exempted to do so. So I've explained that that notices 4 and 5 of 2020 that the FSCA published, which provide these exemptions and some relief in that respect, but only, as I've stated, if it's in relation to consequential to a credit agreement or another commercial agreement. So that scope is limited to that scenarios. So when we've stated also that, you know, if the premium is collected with electronic means, it has to go into that account. And if you have cash, then it's only one business day. So there's not a scenario where that can be collected. Let's say, for instance, the electronic example, that it's collected into a different account and then it's split, because the regulations specifically state that if you receive it electronically, it needs to be in that separate account.
Johann, thank you. That is very clear. But I'm going to continue along this vein because there's another issue that we sometimes get asked. And if you could also please just clarify in respect to credit agreements, and you've mentioned credit agreements. So if we look at a credit agreement specifically, where there's also the credit life insurance that often accompanies the credit agreement. For convenience sake, the client wants to make one payment. So let's say the credit portion is 100 Rand and the insurance portion is 20 Rand. Instead of splitting it and paying two payments, they want to just pay a global 120 Rand and let the recipient split it out for them. Can this be done? Can it be paid as one amount and be split out by the FSP?
So this is allowed under these certain specific conditions that we've touched on. So the regulations do prohibit that this bank account that we spoke about can't contain any monies or funds belonging to the independent intermediary. And that bank account may only hold monies belonging to the policyholder. And as I've stated, there's this limitation causes some practical challenges. And specific example is, for instance, where the intermediary is also the contractual party to another agreement, like another commercial or credit agreement, and we can use a motor vehicle installment perhaps as a good example. So that money belongs to the intermediary. It's the funds of the intermediary, but they also collect the insurance premium. So for that reason, this was provided, this exemption, that the intermediary can collect both the premium and this money belonging to the intermediary, where the intermediary has their own funds coming in because they're the contractual party to this credit agreement or commercial agreement, and they're also collecting premiums. So we have provided this exemption, which has been extended, as I've mentioned, for this reason. So where a combined sum of money is collected, consisting of the premium and the other monies belonging to the independent intermediary in relation to another agreement, then you must meet the conditions that is set out in those exemption, and then this is allowed.
Johann, thank you very much. That's a very practical approach to the legislation. I really appreciate you explaining it so clearly to people. Lezanne, you thought that I forgot about you, but there was a 2019 policy paper. Could you tell us a little bit about the policy paper and what were some of the main proposals from that policy paper, and maybe what's going to happen in the future, if you have any idea?
Certainly. Thanks, Charene. I know you would never forget me because it's such an awe-inspiring topic, this topic of premium collection and the law. But yes, you're quite correct. We, excuse me, let me just take a sip of water quickly. Apologies about that. In 2019, we issued a premium collection, a policy paper setting out the changes that we are proposing in the legislation in relation to premium collection. What informed this this policy paper was, amongst other things, the retail distribution review, the RDR, which is very familiar to the industry. It's a multi-year project that we have been working on. And then also there has been some concerns picked up through supervisory practices. There has been some failures in the market, which was informed by undesirable practices. So what we did is we sat and we thought, okay, how can we improve the legislation to move with the times and to more appropriately make available this activity? Apologies there, Charene. Coughed for a moment, Johann. Okay,
No
so
problem.
On the screen, I put a slide up setting out, excuse me, setting out basically these 5 proposals that are in the policy paper. What we proposed is that as part of professionalizing these activities, that only qualifying intermediaries could collect premium. I said at the beginning, there are these very wide definitions in the law that clumps premium collection together with services and intermediary. And even though we think that it is definitely appropriate because it is factually an intermediary performing these activities, not all intermediaries perform the activities in the same way. And to address these risks that were picked up through the supervisory practices and by the failure in the market, the proposal is that there should be certain parameters which an intermediary has to meet if they want to collect premium. We are also proposing to more clearly in the law, because of these very wide definitions, delineate between if we say something is collection of premium, what does it include? And Johann previously did mention the accounting for premium that has now been described in that specific exemption for direct collection. But I think that exemption already hints towards where we want to go in the future framework. By no means do we want to prohibit intermediaries from collecting premium, because we do believe it can add value, but we want insurers to have the appropriate oversight. We want the business relationship between the intermediary and the insurer to have the right governance practices in process, and that the money is at all times safeguarded. You know that in the law, and I know on the supervisory side, you will also have a dedicated session on this, but the importance of the premium being deemed to have been received by the insurer. So the moment that a policyholder pays premium, it means that that premium is deemed that the insurer has received it. The insurer cannot say the premium sitting with the intermediary and I didn't receive it. The law says if you appoint someone else to collect premium, you must have the right processes in place and you are already on risk. So part of these future developments, we're looking at the qualifying criteria for the intermediaries and that premiums must be treated as trust money. That goes to what you and Johann discussed just now regarding the separate bank account, the need for the right accounting over that bank account. and to make sure that the money is kept safe, that it's not, for example, invested for the value or very illiquid, types of investments, and that money actually belongs to the insurer. I also earlier referred to the 45 days that the time from which the intermediary receives the premium to the time that they need to pay it over to the insurer. One of the proposals is that 45-day period should be reduced. I think generally time has moved on, technology has moved on, and there's no longer a need for that very long period of time between the flow of funds. Practically, it can be done much quicker, and that reduces the risk for the insurer and also for the policyholder, although they have paid the premium. So the premium collection paper set out 5 proposals. The first being, as I mentioned, specifically identifying which activities are being performed as part of premium collection to make sure that the appropriate remuneration is allowed for that in the future framework, what qualifying intermediaries are, and then treatment as trust money, and then also the reduction of the premium remittance period. The last proposal was specifically to allow for an exemption for direct collection of premium. Johann already did explain that exemption is in place, and that was a first step to give effect to this new framework, because we acknowledge that the systems cost money, so there's an appropriate, there is a way to allow for appropriate remuneration. All of these proposals also align to the FSCA's broader move to a more risk-based and a more proportional approach to the industry. We think that regulation should be appropriate, and we have very broad powers to exempt when necessary. So part of the consideration is to also have this different dispensation for lower risk segment of the market. If you think about, for example, very big commercial business, the likes of marine business, and we did allude to this in the policy paper, marine business, aviation business, these types of transactions where the premiums are very big, and it's a very different world to collecting, for example, a small premium on behalf of an individual. So we are also considering how to apply this proportionally in future. Maybe just to that point, 2019, we published the position paper. Since then, we've had extensive industry consultation. And what we are currently working on is refining the framework. So we're going to make proposals to National Treasury of what we think needs to change in the law, because it's the minister that makes the regulations. So these proposals that we put in the policy paper will ultimately be translated into draft legislation. We will request the minister to consult on the draft. It will go out for industry comment. Everyone who watches the webinar will have an opportunity to comment on that legislation. But ultimately, our aim is to have a more appropriate framework that takes into consideration technological developments and that makes sure that the risks are addressed and that there isn't a one-size-fits-all, because that's not the reality of the financial sector. So yes, so that is where we're moving in the future framework. We also do get a lot of questions about when will this happen. The legislative process is a long process. We've got the extensive consultation requirements, that is in terms of the law. But the moment that we publish something for consultation, it goes up onto the FSCA's website. It's a public document. We send out notifications. Anyone is welcome to subscribe to the FSCA notifications from the website so that they get the notifications. And we would certainly welcome consultation from the industry on the future framework when it is published by the minister. I hope that gives you an idea of where we see going in the future.
Thank you, Lezanne. That was very comprehensive. And on a personal note, I have to confirm that the subscription service that you alluded to on the FSCA website really does work. I have subscribed myself, and I regularly get updates to tell me what has been published and where it is and what it's all about. So I want to support you in your urge to people to subscribe and then to comment, because the only way that people on an individual basis can influence legislation is by participating in the legislative process, and the consultative process is their opportunity to participate. And if you don't participate, you're going to have to live with whatever happens. If you did participate, then you might still have to live with whatever happens, but at least you had your opportunity to say your say. And I can promise you that every single comment is considered. Sometimes they contradict one another, and then the challenge for the legislative team, of which the two of you are part, is to then find a way to make it work and to make it as practical and as feasible as possible. Because although industry doesn't always agree with us, I think that they have seen that we really do consult, and we consult in good faith, and we do try to make things as practical as possible. The exemptions that Johann has expanded on in depth really is a way in which we can see that comments have been considered, that requests have been considered, and that certain exemptions have been made to try and make things work better. So thank you so much again to both of you to helping us navigate this very complex world of premium collection and the legislation, both from a phase side as well as from the life and the non-life, the long-term and the short-term insurance legislation perspective. It's not always the easiest way in which to do things. It can become very complex, and I think you've done a really good job at explaining it in a very practical way. So thank you for your time, and I hope to see you again in the future in a webinar.
Thank you for the opportunity, Charene. We appreciate it.
Thank you so much. And to everyone who watched it, if you missed anything, you're welcome to rewatch it. Thank you so much. Have a wonderful day.